In April 2023, Bed Bath & Beyond did something unthinkable. It didn't announce a new strategy. It didn't unveil a turnaround plan. It filed for bankruptcy. This was not a struggling startup. This was a retail empire that once generated over $12 billion a year, operated more than 1,500 stores, and sat inside the daily lives of millions of American households. And then almost overnight it was gone. Stores emptied, shelves stripped bare, employees locked the doors for the last time. A brand that once dominated American suburbia collapsed into nothing. What makes this story truly shocking is not that Bed Bath & Beyond failed. It's how it failed. This company did not die because people stopped buying towels or kitchenware. It did not die because Amazon existed. It died because of a series of decisions made at the top that quietly dismantled the very foundation that made it successful. This is the story of how one of America's most recognizable retail giants destroyed itself from the inside out. Long before bankruptcy headlines and liquidation sales, Bed Bath & Beyond was one of the most powerful retailers in America. The company was founded in 1971, long before e-commerce, long before Amazon, and long before shopping malls began to die. Its idea was deceptively simple: sell everything a household could possibly need, under one massive roof, at prices that felt fair. And it worked. By the late 1990s and early 2000s, Bed Bath & Beyond had become a textbook example of a category killer. Walk into one of its stores, and you would find towering shelves packed with towels, bedding, cookware, small appliances, storage bins, thousands of products stacked from floor to ceiling. The stores were chaotic, but they were irresistible. Then there was the coupon. The infamous 20% off coupon became a cultural artifact. It arrived in the mail, sat on kitchen counters, lived in glove compartments. Customers didn't just shop at Bed Bath & Beyond, they planned to shop there. The coupon created habit, loyalty, and a sense of victory at checkout. At its peak, the company operated over 1,500 stores, employed tens of thousands of workers, and generated more than $12 billion in annual revenue. For years, Wall Street loved it. Suburban America depended on it. Competitors feared it. This was not a fragile business. It was not a niche brand. Bed Bath & Beyond was woven into everyday American life, and for a long time, it looked unstoppable. This is the moment where everything began to unravel for Bed Bath & Beyond. For decades, the company's success was built on a simple formula: familiar national brands, endless choice, and irresistible coupons. Customers came because they trusted what they recognized. They knew what they would find. They felt safe spending their money there. Then in 2019, leadership decided that formula was outdated. A new strategy took shape at the top, one that looked brilliant on spreadsheets and disastrous in real life. Executives believed Bed Bath & Beyond had a fundamental problem. Its margins were too thin, national brands were expensive, coupons were eating profits, and competitors were squeezing prices, so they made a bold decision. They would replace well-known brands with private label products. They would cut back on coupons, the very incentive that drove traffic. And they would retrain customers to buy what the company wanted to sell, not what customers came for. Internally, this decision was framed as modernization. Private brands promised higher margins. Fewer discounts meant cleaner balance sheets. Leadership believed customers would adapt, just as they had at other retailers. But this assumption ignored one brutal truth. Bed Bath & Beyond did not own customer loyalty the way it thought it did. Shoppers weren't emotionally attached to the brand's name. They were attached to the products, the variety, and the deal. When familiar items disappeared from shelves, customers didn't feel excited by something new. They felt confused, then frustrated, then betrayed. And the timing could not have been worse. As the retail environment became more competitive and consumer confidence weakened, Bed Bath & Beyond chose that exact moment to experiment with its identity. Instead of doubling down on what worked, it tried to reinvent itself while standing on shaky ground. This was not a single bad quarter. This was not a temporary misstep. This was a strategic pivot that quietly severed the relationship between the company and its core customers. Traffic slowed. Inventory piled up. Sales dropped faster than leadership expected. And by the time executives realized customers were not coming back, the damage was already irreversible. The backlash against Bed Bath & Beyond was not slow. It was instant, loud, and unforgiving. Customers didn't write polite emails. They didn't wait for explanations. They simply stopped showing up. Social media became the first battlefield. Longtime shoppers flooded comment sections with the same complaint. The store no longer felt familiar. People posted photos of half-empty shelves, confusing layouts, and private label products they didn't recognize or trust. The tone wasn't curiosity. It was anger. Then Wall Street joined the chaos. In 2022, the company was suddenly dragged into meme stock culture. Online forums turned Bed Bath & Beyond into a speculative casino chip. The stock price exploded and then collapsed just as violently. When activist investor Ryan Cohen exited his position, panic spread instantly. Retail investors felt burned. Trust evaporated overnight. Financial media poured gasoline on the fire. Television segments dissected the company's losses in real time. Commentators questioned whether management had lost touch with reality. Even figures like Jim Cramer openly debated whether the brand was already beyond saving. The narrative hardened fast. This wasn't a company in transition. This was a company in denial. Memes mocked the endless store closures. Viral posts counted down how many locations were left. Former customers joked that the famous coupons now meant nothing because there was no reason to walk through the doors anymore. The backlash became self-reinforcing. Negative headlines scared suppliers. Suppliers tightened terms. Shelves became emptier. Each bad quarter fueled another wave of online outrage. At this point, the collapse was no longer happening quietly inside boardrooms. It was unfolding in public, day by day, on the internet where reputations die much faster than companies expect. By the time the public backlash peaked, the numbers behind Bed Bath & Beyond told a far more brutal story than social media ever could. The decline was not gradual. It was a free fall. At its height, the company generated over $12 billion in annual revenue. Within just a few years, that number was cut almost in half. Quarter after quarter, sales missed expectations. Store traffic collapsed. Inventory sat unsold while cash drained away. Losses stacked up relentlessly. In a single year, Bed Bath & Beyond burned through billions of dollars. Gross margins shrank. Operating costs stayed high. Debt became harder to service. What once looked like a temporary downturn hardened into a structural failure. Then came the store closures. Hundreds of locations were shut down in rapid succession. Each closure saved short-term costs, but destroyed long-term scale. Fewer stores meant weaker supplier leverage. Weaker leverage meant higher costs. The spiral accelerated. By 2023, the numbers were impossible to ignore. The company reported more than $5 billion in liabilities, while its assets could no longer cover the damage. Cash reserves were nearly gone. Credit lines tightened. Vendors demanded payment up front. The stock price told the same story. Once valued as a retail powerhouse, the shares collapsed to pennies. Trading became volatile, disconnected from fundamentals, and finally meaningless. The market had already written its verdict. This was no longer a turnaround story. It was a countdown. When the bankruptcy filing arrived, it didn't shock analysts. It confirmed what the numbers had been screaming for years. The business model had broken. The cash was gone, and there was no realistic path back. At this stage, collapse was not a possibility. It was a certainty. To understand why Bed Bath & Beyond could not recover, you have to look beyond headlines and focus on the mechanics of how the business actually worked. How leadership systematically broke it. The first failure was a fundamental misunderstanding of the customer. Bed Bath & Beyond believed it owned loyalty. In reality, it only rented it. Customers were not emotionally attached to the brand itself. They were attached to choice, familiarity, and perceived value. When management replaced national brands with private labels, it assumed shoppers would follow out of habit. Instead, shoppers treated the store like any other interchangeable retailer and left. The second failure was strategy divorced from reality. Private brands work when customers trust the retailer more than the product. That model succeeds at companies built around design, identity, or lifestyle branding. Bed Bath & Beyond was neither. Strength had always been abundance, not curation. By forcing a margin-driven strategy onto a volume-driven business, leadership destroyed the very engine that generated traffic. Then came the leadership blind spot. Decisions were made through financial models, not store floors. Executives optimized for gross margin percentages while ignoring early warning signs, declining foot traffic, rising customer confusion, and eroding basket sizes. By the time internal reports reflected the damage, customer behavior had already shifted elsewhere. Timing made everything worse. These changes happened during one of the most fragile periods in modern retail. Competition intensified, consumer patience shrank, and supply chains became unstable. Instead of reinforcing trust, the company experimented with its identity at the exact moment stability mattered most. Finally, there was no margin for error. Years of aggressive share buybacks had drained cash that could have funded experimentation or digital reinvention. When the strategy failed, Bed Bath & Beyond had no financial cushion left. There was no second attempt, no reset button. The collapse was not caused by one bad idea. It was caused by a system that rewarded short-term financial optics while ignoring long-term customer behavior. At that point, bankruptcy wasn't bad luck. It was the logical outcome of a broken strategy meeting an unforgiving market. When the strategy failed, the consequences inside the company were swift and brutal. The first casualties were the people at the top. Executives who had championed the transformation quietly disappeared from earnings calls. Public confidence in leadership collapsed alongside the stock price. Within a short span of time, the company cycled through emergency plans, interim roles, and internal reshuffles, none of which addressed the core damage already done. Behind closed doors, the atmosphere turned toxic. Board meetings shifted from growth discussions to survival debates. Every decision became reactive. Cut costs, close stores, preserve cash. Each move was designed to buy time, but time was the one thing the company no longer had. Then came the human cost. Thousands of employees lost their jobs as store closures accelerated. Longtime workers who had spent decades with the company were suddenly disposable line items on restructuring spreadsheets. Morale collapsed. Talent fled. The institutional memory that once made the business run smoothly evaporated. Leadership credibility vanished completely. Investors no longer believed in recovery plans. Suppliers demanded stricter terms. Partners pulled back. Even internal teams stopped expecting a turnaround. The organization entered a state of quiet resignation, where everyone understood the same unspoken truth. The end was approaching. No executive announcement could reverse it. No strategic memo could fix it. By the time bankruptcy became inevitable, leadership wasn't steering the company anymore. It was simply managing the fallout. It wasn't a heroic failure. It was a slow surrender where decision-makers paid with their reputations. Employees paid with their livelihoods, and the company paid with its existence. The collapse of Bed Bath & Beyond offers lessons that reach far beyond retail. The first lesson is simple and unforgiving. Customers do not adapt to strategy. Strategy must adapt to customers. Leadership believed shoppers would accept unfamiliar products, fewer choices, and higher friction in exchange for a cleaner balance sheet. Instead, customers responded with silence. They didn't protest, they didn't negotiate, they left. In modern markets, indifference is more lethal than outrage. The second lesson is about false efficiency. Cutting coupons, pushing private labels, and optimizing margins looked efficient on paper. But efficiency that destroys demand is not efficiency, is liquidation in slow motion. Bed Bath & Beyond optimized the business for a future that never arrived. While dismantling the present that still worked, the third lesson is about trust as a strategic asset. Trust is built quietly and destroyed quickly. For decades, customers trusted Bed Bath & Beyond to offer familiar brands, endless choice, and reliable value. Once that trust was broken, no marketing campaign could restore it. Loyalty, once lost, does not return on a quarterly timeline. Finally, there is a leadership lesson. When decision-makers prioritize financial optics over human behavior, they confuse control with understanding. Spreadsheets can explain margins. They cannot explain why people feel betrayed when a brand changes its identity without permission. Bed Bath & Beyond did not collapse because it failed to innovate. It collapsed because it forgot who it existed for. And in business, that mistake is rarely survivable. The story of Bed Bath & Beyond leaves us with an uncomfortable question. Did this company collapse because the retail world changed too fast, or because leadership changed the company in ways its customers never asked for? Once a brand becomes woven into everyday life, it carries an invisible responsibility. Break that bond, and no amount of capital, consultants, or emergency strategies can repair it. If you found this story valuable, subscribe for more deep dives into the rise and collapse of iconic business empires. These are not just stories about companies, they are warnings written in real money, real jobs, and real consequences. And now, I want to hear from you. Which company should we analyze next? Another retail giant? A tech empire? Or a brand that looks unstoppable today, but may already be cracking beneath the surface? Leave your thoughts in the comments.